Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis, welcoming you to my podcast Money Talk for Friday the 21st of July. Thank you for making this podcast one of the most listened to podcasts in Hong Kong and Singapore on Apple Podcasts. As well as finding us on Apple, we're also on Google Podcasts, Spotify and Substack. Just search for Peter Lewis's Money Talk. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, China's one-year loan prime rate, which is the medium-term lending facility used for corporate and household loans, was left unchanged at 3.55%. The 5-year rate, a reference for mortgages, was kept at 4.2% in line with market forecasts. US jobless claims fell by more than expected last week. The number of US applications for jobless claims fell by 9,000 to 228,000 in the week ending July the 15th. That's the lowest level since mid-May, and consolidating Fed officials' calls for another 25 basis point rate hike in its meeting next week. India, the world's biggest rice exporter, is banning exports of non-basmati white rice in an attempt to ward off looming domestic price rises. Heavy rains have hurt crops in the country, and rice prices have risen by more than 11% over the last 12 months. The ban will affect about a quarter of India's rice exports and risks sending global food prices even higher. India accounts for about 40% of the global rice trade, and Asia consumes about 90% of the global supply of rice. And wheat prices have risen sharply on global markets after Russia bombed Ukraine's port cities for a third consecutive night. The airstrikes on Ukraine's Odessa region ports have destroyed 60,000 tonnes of grain and damaged storage infrastructure. Joseph Borrell, the EU's foreign and defence chief, said if this grain is not only stopped but also destroyed, this is going to create a huge food crisis in the world. Wheat prices have risen for 3 consecutive days. On Thursday, the most actively traded wheat contract on the Chicago Board of Trade settled around 1.4% higher, notching a 3-week high. It follows a jump of 8.5% in the previous session, which was the biggest daily gain in more than a year. On today's programme, I'm joined by Francis Lund, the CEO of Securities, and John Schofield, Managing Director of Tempus Investment. With a view from Australia is Toby Lawson, the CEO of Statton Partners. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com. Peter Lewis's Money Talk. On Wall Street, the Dow Jones Industrial Average jumped for a 9th consecutive day on Thursday. It's the Dow's longest daily winning streak since September 2017. But the broader market suffered after declines in Netflix and Tesla, which had reported underwhelming earnings a day earlier. The 30-stock Dow, which has less dependence on tech stocks, added 164 points, or 0.5%, to close at 35,225. It was boosted by shares of drug maker Johnson & Johnson, which rose over 6% after it hiked 4-year guidance. The S&P 500 slipped 0.7% to 4,535. The Nasdaq Composite slumped 2.1%. That's its biggest one-day fall in more than 4 months to finish the session at 14,063. Shares of Tesla fell 9.7%, the biggest single one-day drop since early January, after profit margins slipped as a series of price cuts weighed on the electric car maker's earnings. Meanwhile, Netflix missed sales estimates and posted lower than expected guidance for the following quarter. Its shares dropped 8.4%. It was the stock's biggest one-day drop since December 2022. Semiconductor stocks pulled back after Taiwan semiconductor manufacturing reported profits plunged 23% in the second quarter, and it offered weaker than expected sales guidance for the year. The Philadelphia Semiconductor Sector Index dropped more than 3%. US-listed shares of Taiwan Semiconductor declined 5%, while Intel and Nvidia each shed over 3%, and AMD dropped more than 5%. Treasury bonds saw heavy selling following the jobless figures. The benchmark 10-year Treasury yield, which moves with inflation and growth expectations, rose 11 basis points to 3.85%, its largest one-day yield increase of the month. The 2-year yield, which moves with interest rate expectations, rose 8 basis points to 4.83%. And the US dollar index, which measures the currency against a basket of peers, rose 0.5%. The Chinese yuan rose 0.7% in Shanghai to 7.1761 renminbi as the People's Bank of China adjusted some rules aimed at increasing companies' ability to raise funds overseas. China's major state-owned banks were seen selling dollars to buy yuan in the offshore spot market on Thursday to support the currency. Hong Kong's Hang Seng Index extended losses into a third day, losing 24 points, or 0.1% to 18,928. The tech index fell 1.2%, its fourth day of declines. Sunny Optical tumbled 13.7%. after warning that profit would sink by 65 to 70% in the half year to June from the same period last year. And mainland Chinese markets were also lower, with the Shanghai Composite Index down 0.9% at 3,170. And futures markets are pointing to a small loss for the Hang Seng at the open this morning of about 20 points or 0.1%. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Always happy to see you in the studio on a Friday morning, Francis Lund, the CEO of Securities. Morning, Francis.
Hi, good morning.
And joining us this week, John Schofield, Managing Director of Tempus Investment. Morning, John.
Good morning, Peter.
Now, China has vowed to treat private companies the same as state-owned enterprises, according to a joint statement from the Communist Party's Central Committee and the State Council. They released a 31-point action plan which vowed to improve the business environment for private companies. The statement also said that governments at various levels are also encouraged to invite entrepreneurs for consultation before drafting and evaluating policies. Furthermore, it will support share listings and bond sales of private firms, as well as support private enterprises in expanding overseas businesses. So, Francis, what do you make of that, first of all?
Well, this is just an official document, but we want to see some actions because ever since 2020, the government has been treating the private enterprises very harshly, levying record fines and everything else, restricting their market share. But the upshot was this unemployment rose sharply, especially among the young people, because the private enterprises are not hiring anybody. So I think the government recognized its mistake and tried to rectify it. But what's the result? The jury is still out. It's too early to say.
John, do you think China can do this? Can it really treat private companies as well as it treats state-owned enterprises? Because, as Francis says, it hasn't been able to do so in recent years, has it?
Well, I think it's a case of show me, and I think it's going to take a while for people to be convinced. We saw a chorus of approval from the big private sector bosses. But you wonder, well, yes, we're going to support you. We're going to support you by using bureaucratic means, and that the recent shift towards having, Communist Party officials embedded within all enterprises. We're going to have to see how that works out.
Mm. I mean, this is not policy, is it? It's a document, but it's not the same as policy.
Yes, it's more like administrative procedures. Mm-hmm. But as I say, there's no hint from there that equal treatment for the private sector means being managed in the same way as the public sector companies are. Is one possible interpretation.
Mm-hmm. I mean, what was interesting was the way China's billionaires really piled in to praise Xi Jinping's private sector reforms. First of all, we had Pony Ma, the founder of Tencent. He praised President Xi's efforts to reform the country's private sector. He said President Xi's proposals for stimulating the sector have advanced our sense of responsibility and mission to create value for users, industry and society. We should bear in mind, by the way, that Tencent was fined over $400 million by the PBOC earlier this month as part of that crackdown, and then Mr. Ma, I mean, he rarely voices his opinions, doesn't he? And then he was joined by Xiaomi co-founder Li Jun. He wrote a separate editorial who called it a clear policy signal for companies to push forward with high-quality developments and contribute to the modernisation of science and technology. And then we had soft drinks magnate Zhong Guingzhou said his group Wahaha would take the path of serving the country and not let down the party or the state. And another 13 local entrepreneurs all joined in. I mean, if this wasn't such an obviously coordinated sort of move, show of support, it will probably be a little bit more effective, wouldn't it? But it's so obviously sort of coordinated to time with this new sort of document from the State Council.
Yeah, I think the Communist Party just cannot stop grandstanding everything. They want everybody to be unanimous in praising the central government. So I think this is what you get. And of course, the hypocrisy is there. Everybody can see it.
I mean, when they talk to you privately, Francis, when you speak to a lot of the firms on the mainland, private companies on the mainland, are they saying to you, you know, what a great job Beijing has done in supporting private companies and how much they're looking forward to?
No, they don't say that. They said that they just want the government to keep out of their businesses.
Right. Why is this happening, John, right now? Is this to do with the economic data that we've had out recently, which was showing a sharp slowdown, wasn't it? And so China really needs its private companies to invest and to boost growth and to hire people.
Yeah, I think the penny's dropped that they've created a problem. And so now they're going to have to find a way of which has had many, unintended consequences, but perhaps predictable consequences. And now they're going to try and find a way of, sidling out of it. Whether we will see as an abrupt a U-turn as we did on COVID lockdowns, I doubt. But yeah, fine, okay. So what's going to happen next? We just all have to wait and see. But I think you're right. I think another big statistic earlier this week was the fact that China has zero inflation, and in fact, as we know, is exporting deflation in terms of ever lower prices for its manufactured goods exports. Which is probably having a beneficial effect, at least at this stage, in the West, and in terms of headline inflation.
But if it wasn't for services, there would be deflation, wouldn't there? A real deflation on the mainland.
Yes, because of the overproduction and price cutting of a whole range of goods.
Yeah. What do you both make of this 11-point blueprint to boost demand that the National Development and Reform Commission came out with earlier this week? They want to boost consumption amongst sort of householders, so they're encouraging them basically to go and redecorate their homes, buy more domestic items and so on. What do you make of the plan that they came up with, this 11-point blueprint to go and do that?
But this is old stuff. It's nothing new. We had that before. So I doubt it will be effective at all. I think some things unless you give people money, you just cannot tell people buy something like that. Like in Hong Kong, you give people $5,000 and they go out to spend. So when you want to create demand, you have to give people money. You cannot just say things. These are empty gestures.
Yeah, and this doesn't create any new money for them, doesn't it? It's not like a consumption voucher is coming or something, which would give you some real money to go out and spend. But also, isn't it true that Chinese households, it's not that they don't have money to spend. They actually do have money to spend, don't they? They have savings.
They have enormous savings.
Yeah, and they have access to credit. It's not even that credit is difficult to come by. It's just that they don't want to spend at the moment. So how do you change that?
Well, the problem is that you need inflation, because if you believe the price is going up, you will go and buy things like property prices. If the property prices are falling, nobody will go and buy a flat.
Yeah.
That's pure and simple.
Yeah, so then it's important that the government in Beijing takes steps to make sure China doesn't slip into deflation, because that's going to be disastrous, isn't it, for the economy?
Definitely. We had that before.
Yeah. John, what do you think of this plan?
Yeah, I think the big issue is missing from the plan, and that's how to reliquify and get confidence back into the property market. Mm-hmm. I mean, that's the key for everything. Once you get into a sort of virtuous circle on that score, people are buying flats or moving flats, and then buying new carpets, fridges, cookers, etc., then that's what gets the domestic consumption market moving. Mm-hmm. So I think all efforts should be, because as we've said many times, it won't be easy, it won't be quick. It's a multi-year thing rather than, but getting the ghost apartment buildings finished, and then start to discount prices or whatever. Do auctions, do lucky draws, anything to get people, to get the market moving again. It's liquidity rather than. The focus is maintaining the price level. Of course, that's impossible. You'll just end up with a zombie situation, like Japan did. Over 20 years or so. So. We've got to get liquidity back and confidence back into the property market. Even that means taking a hit and a haircut, loans from some developers, much more aggressive restructuring in that sector and so on.
So what have they got to do in the property sector? Because that's the real challenge, isn't it? Because it's such a large part of the economy, and the funding model for developers is now broken. Yeah,
that's a really tough job, because to save it, I think you need many trillions of dollars. Look at just one company is indebted to the tune of 2.4 trillion yuan. It's almost as big as the Hong Kong economy. I don't think the government is inclined to pour so much money into the property sector. It's a really tough job.
I mean, if we look at the investment in the property sector from the data, it collapsed almost 8% in the first 6 months of the year. So it's not really getting any better, is it? It's not stabilising. We thought it might be at the beginning of the year, but now it doesn't seem to be. And on top of that, we've got other problems for the economy as well. Exports, they're down 7.5% in May. The problems seem to be mounting up for the mainland economy.
Yeah, I think for the property sector, the problem is really oversupply, except for the first-line cities. And for every other city and counties, you have 20% oversupply. And with the population not growing, it will be very, very difficult to buy up all those vacant flats.
And the other big problem, of course, is the youth unemployment rate, isn't it? That's another issue. 21.3%, a record high. Businesses, it's not that they're not just reluctant to hire new staff; they're not really in a good position, are they, to hire new staff at the moment?
No, of course, the private sector's not be hiring for the last 2 years. But I think the biggest hit was really in the ban on tutoring schools. I think from what I learned, something like 20% or 25% of the young graduates actually got employment in the tutoring school. And if you close them, then many people will go unemployed. I think this is one of the policy disasters, and parents are actually going underground to get tutoring for their children. So it's a nightmare for all the parents and actually for the country as well.
What about the foreign environment? That's another tough situation, isn't it? China's Commerce Ministry on Wednesday said non-economic factors were growing and interfering with the country's foreign trade, and it was described as facing an extremely severe situation in the second half of the year. So just to remind you of the figures, the dollar value of China's exports, they plunged 12.4% in June from a year ago. That was worse than the previous month's decline of 7.5%. Another area, really, where things seem to be getting worse.
Yes, that's a very interesting phenomenon. Of course, part of the decrease is to do with price cutting, but the American administration's policy, Inflation Reduction Act and so on, giving incentives for U.S. companies to manufacture more at home or in nearby countries such as Mexico are really starting to bite. There are exceptions, though, interestingly. For example, they've had to back off on solar panels because solar panels, China has an overwhelming market share in that sector. Something like 80% of world solar panel supply comes from China. So they haven't been able to yet find a way of replacing that. But it just shows you what can happen. At the same time, the apparent trade war in the high-tech sector is interesting.
Yeah.
I think the way the Americans are playing, I think, quite a clever game now. I see they're talking to China again on a whole series of issues and trying to normalize everything except they don't want China to get hold of the very high-end chip making technology, etc. And that's what China is screaming about. We want your best toys. So you get this extraordinary contradictory attitude. Oh, we're going to ban, micron chips because they're a danger to our society. But on the other hand, they want to have other chips, the best chips. Well, the ability to make them. This is the key thing: the ability to make them.
Can these issues be separated out? I mean, John Kerry, who was in Beijing earlier this week, was saying, things like climate change issues, for example, they're not dependent upon the overall economic relationship. We can still talk about this despite what's happening elsewhere. Now, Wang Yi disagrees. He says, no, this is all, this is all within the same ambit of overall sort of relations. And they're talking about now they're going to retaliate if the US introduces an investment ban. We had the Chinese ambassador to Washington saying we can't just simply sit idly by. So there's the potential for this to get worse, isn't there?
Well, that's the American strategy. It's not easy to combat from the China perspective. What can they do? They say, okay, well, in that case, we're going to build even more coal-fired power station, or something like that. And they're doing it anyway, despite 52-degree temperatures in Xinjiang. So, I just think it's a very interesting development and quite clever.
The Americans just want things their way.
yeah, that's right. They have in the last year or so.
But it is having an effect, isn't it? These export controls on semiconductors. There's no question that it's impacted China's economy and it's impacted China's development. Even though the US says it doesn't want to hold back China's development, it is having the effect of doing that, isn't it?
Yeah, definitely. I think China is feeling the squeeze on semiconductors. No doubt about that.
Yeah. What about an investment ban? What impact will that have on both US firms and also on China if this comes to pass?
I think the American companies will miss out on the China market. I think what you have is really the European companies, especially the German companies like Volkswagen, that take advantage of it. So as far as the investment goes, it is not that there's no alternative. There is alternative. So America may be hitting itself.
But maybe the Americans will put pressure on the Europeans not to step into and fill the hole when they pull out of investing into China.
Yeah, they try to do that with South Korea, but I doubt that will succeed. I really doubt that.
And also the other area where things didn't really work out either in terms of agreement with China is on debt relief. We had the G20 finance ministers meeting in India earlier this week. Once again, the G20 failed to issue a communique because they couldn't agree, first of all, on debt relief and then also on the wording about Russia's invasion of Ukraine. What is the issue on debt relief that's stopping them here from agreeing to try and relieve the pressure on poor developing nations?
Well, as I understand it, China's sort of gone out on a limb, really, or went out on a limb with the whole Belt and Road stuff and doing infrastructure projects all over, South and Central Asia and parts of Africa and so on, and on a unilateral basis, providing, the whole package. The loans, the construction company, even importing the labour to do the infrastructure thing. So that debt is kind of standalone debt, and it is not covered by, overarching IMF arrangements or World Bank arrangements. As I understand it, China insists on effectively negotiating bilaterally.
So it wants the IMF and other lenders to share in the debt relief, doesn't it? So some of these projects now that China has lent to have gone bust. There's no chance of the countries paying the money back. So there's going to be write-downs, but China wants other countries now to share in the losses. Is that correct?
As I understand it, that's right.
Yeah, like Sri Lanka has no ability to repay the debt to China.
So how is this going to be resolved? Because you can imagine that other countries are going to say, well, look, we didn't lend the money. We didn't have the lax lending standards here. We advised you not to go and do this, but now you want us to bear the losses.
I don't think IMF is ready to make up for China's loans. Certainly not.
Can you see anywhere where there is agreement, where there is improvement? What about on climate change? We had John Kerry in Beijing earlier this week. They have agreed, haven't they, to sort of restart the stalled global warming talks. But then at the same time, President Xi said we're going to go our own way and, create our own path to reducing carbon emissions, not going to follow other nations. So even though they're talking, does that sort of rather block the road ahead in terms of some sort of agreement?
Yeah, I think so. I think it just showed that China is not in America's camp, even though they have the same goal of cutting greenhouse gases. But the thing is, even though China has the biggest solar power network electricity in the world, but it's still building a lot of coal-fired power plants. There is still a shortage of electricity in China. I don't think solar power can replace it. That's the problem.
And if they want to meet the commitments that they made to getting emissions down, getting peak emissions by 2030, and then achieving net zero emissions by 2060, they've got to basically reduce coal demand in China to zero.
I think that's an impossibility. I think all this green stuff is really too idealistic. Practically, I don't think any country in the world can do it.
Right. Well, that's a depressing thought. But yes, a lot of depressing news this week in some ways as well. But thank you very much for coming in. Have a great weekend. That's Francis Lun, who is the CEO of Securities. John Schofield, who is Managing Director of Tempus Investments.
Peter Lewis's Money Talk.
I'm joined now by Toby Lawson, who is the CEO of Statton Partners down in Australia. Morning, Toby.
Yeah, good morning, Peter.
Let's start with some data. Unemployment, unchanged, 3.5%, pretty close to a 50-year low, isn't it? This is presumably one of the figures that the Reserve Bank of Australia is watching pretty closely in terms of deciding what it's going to do next on interest rates.
Yeah, it was a good number. So the employment number was expected to come in around 25,000 new jobs, came in at 32.5. As you mentioned, unemployment rate at 3.5, unchanged. They were expecting it slightly higher at 3.6. So for the market, it was slightly surprising, not a dramatic shift from the expectation. But what it did was it zoomed that focus in that the RBA are going to potentially have to hike because the labour market remains tight. So all the press this morning and probably the market reaction reflected that, where the Reserve Bank are likely to probably go one more at least, maybe in August. And one of the things I'll be looking at is, to look at how the Fed are going to move the week before, because that might give them some air cover if the Fed go 25.
And we had the minutes, didn't we, from the last RBA meeting where they stayed on hold, didn't they? And there was a lot of debate beforehand about were they going to go and do another rate rise, were they going to go on hold? What are those minutes saying about the stance at the moment and what the RBA is looking at?
So there's a clear recognition that things have slowed from an inflationary perspective on the cost push side of the equation. Prices have come down on the supply side of it. What concerns them, though, are two factors, which is one we've just discussed, which is the labour market. It's still tight. And around that labour market tightness is a lack of increase in productivity, at least measured at the moment, in terms of unit labour cost. And also a Labor government here that's probably likely to be under pressure from unions to push wages higher. So this is the RBA's concern around the employment sector. And then in the housing sector, what appears to be almost I wouldn't say a resurgence, but a revitalisation of the housing market. Surprisingly so, given the higher interest rates, we're actually seeing prices on property going up. And so that idea that was going to slow things down and bring inflation down a bit quicker may give pause to the Reserve Bank. So they're the two concerns that they have on the fact that inflation may be stickier, and they may need to just push the pedal a little harder before they can be confident that they've got inflation untamed.
The situation the RBA is in seems to mirror pretty well what a lot of other central banks are in, like the Fed, the ECB, the Bank of England. They've got similar problems, haven't they? Which is that inflation is coming down now. The data seems to clearly show that inflation has peaked, even in the UK, where it was very high. It's come down now to 7.9%, high level, but at least it's coming down. They all seem to be talking about a tight labour market, though, so they've got to go at least one more time with terms of interest rate hikes. It's interesting, isn't it, how all the central banks, maybe with the exception of some of the Asian ones out here, like the Bank of Japan and the People's Bank of China, but certainly in the West and in Australia, they're lining up in the same way.
Yeah, and interestingly, the incoming Reserve Bank Governor, Michelle Bullock, gave a speech in relation to what would be the non-accelerating rate of unemployment. Non-inflation accelerating rate of unemployment, which is the NAIRU, which is an economic theory. And with unemployment rate at 3.5%, in the Reserve Bank's view, unemployment should be closer to 4.5% to reduce the inflationary impact of tight labour markets. Mm-hmm. So in that sense, if you draw the correlation, then rates can go higher to force more unemployment without doing damage to the overall, full employment mandate or the stable employment mandate of the Reserve Bank. So, yeah, the indication is that the tight labour markets are a bit of a conundrum for central banks, and that the idea that these tight labour markets probably give central banks a chance to put more weight on interest rates to reduce demand and thereby increase unemployment to the extent that gives it a non-inflationary impact. So, sorry to confuse, but that's essentially what our central bank are looking at, is that they can probably force interest rates higher to get unemployment a little higher than where it is now, to rein in the inflationary impact of tight labour markets.
But there are people who are worried that they could all go too far and tip the economy into recession, although the talk at the moment does seem to be that right now the economy is in a sweet spot where the central banks have got inflation down without actually, well, certainly in the US anyway, without actually tipping the economy into recession. And notice Goldman Sachs, they slashed their probabilities of a recession down to 20%. So people seem to be getting excited about the position the economies are in at the moment.
Yeah, I think the expression is that Goldilocks scenario for the US economy and US earnings, which we're currently in the middle of. I think about 75% beat so far on earnings, sort of puts credence to the soft landing argument. Whilst we're seeing a decline in earnings, they're still doing better. There's not been any dramatic. Some of the growth stocks came off a bit sharper, but they were a bit frothy in price anyway. More of the value stocks performed pretty well, at least in the short term overnight. So yeah, I think the market is reasonably confident at this stage that we're going to achieve that soft landing that the Fed have been trying to navigate. So. And that's reflected, obviously, in stock prices over the last couple of months.
Next week, it's going to be an important week then, isn't it? The Fed is meeting, the European Central Bank is meeting. We pretty well know what they're going to do. The Bank of Japan, they're also meeting as well. Seems to be more uncertainty there. People were sort of thinking that maybe Governor Ueda will abolish yield curve control, although he was saying this week he didn't see any reason to change sort of monetary policy. But it is going to be an important week next week, isn't it, with these three central banks?
Yeah, I think the Bank of Japan got a slightly higher inflation figure today at 3.3. If you look at the history of Japan over the last 25 years, they've been quite happy to have some inflation. So you sort of tend to think that they'll probably err on the side of pretty much holding it. ECB, you mentioned, yeah, that looks pretty clear. The Fed's the interesting one because, in the lead up to it, it would suggest that despite the quite sharp decline in inflation, and at the headline level and somewhat at the core level, if you strip out the housing cost, then 25 basis point hike's a bit of a surprise, but that's where the market is right now. So it'll be a key one. And I suspect that if they do go, it might be the last, at least in the short term, or that if they don't go, it'll be that they're pausing, but they're going to keep that language pretty hawkish to say that there's more in the pipe.
I mean, the dot plots were talking about 2 more rate hikes before the end of the year, weren't they? So the markets seem to be diverging from the Fed once again.
Yeah, and I think that partly that's language from the Fed, partly that's managing expectation. That often had this discussion around inflation expectation and avoiding it. They've contained it now, they've got it down. It's not quite there, but they just don't want to let it out again. So even if they don't go in terms of a hike, I would expect that the language is still pretty firm and the dot plot won't change. So it's either go now and 25 they can probably absorb, or they wait, but they'll be very clear that those 2 hikes are still in the pipeline.
So what is it now that investors need to see to keep this sort of quite extraordinary stock market rally that we've had in the US sort of going? I mean, they're anticipating, aren't they, at least one more rate hike anyway next week. But what needs to happen now to keep this rally, keep its legs running?
Well, I think part of what we've had, and this is something to be aware of, in the last couple of months, you've got less liquidity in the market. So, and we also had quite a significant short position probably in the derivatives market in equities. So part of what I think the rally has been over the last month or so is maybe a little bit of people reversing their short positions, at least at the investor, at the sort of trader level. And I think that would be reflected in some of the futures markets and the derivative markets. So there probably was an overweight short position in the market, and that's had to be unwound in probably illiquid conditions. So once I think we get out of the summer months in the US, start to see some more constructive data, review the corporate earnings season most recent and the forward guidance, see how inflation appears, I think we'll get a better read on whether the market can sustain this rally. I still think it's too early to say. Because I think the last few months have been quite light in terms of liquidity, and I think we've seen probably a few quite large positions who are tipping short into the market, got that wrong, and have turned that around. So that's something to consider.
The nature of the rally seems to be changing, doesn't it? We've had this 9-day rally in the Dow, whereas the Nasdaq was down 2%. It seems to be, well, maybe broadening out is the right way of looking at it, from these tech stocks into other types of companies now. And we're seeing, more S&P 500 companies reach new all-time highs. Is that all a positive sign?
Yeah, well, if the broader market's getting better results, so people will be looking at a value So the stocks, if they're based on earnings multiples, would be looking at the broader index and saying, okay, there's some stocks of value there. Growth stocks obviously had a good run. They'd been underperforming the previous year and picked up. And I think that's probably partly a little bit of exuberance on the growth side. And those growth stocks are coming back a little bit. They're a bit frothy. And maybe when that happens is, maybe people just pivot out of that growth, maybe a little bit over the top and come back into value where there might be see some more, better value in terms of the pricing on some of the more, less sexy stocks, I guess, for want of a better expression.
Okay. Well, Toby, thanks very much for talking with me this morning. Have a great weekend. Enjoy the cricket over the weekend. That's Toby.
Thank you.
That's Toby Lawson, who is the CEO of Statton Partners down in Australia.
Peter Lewis's Money Talk.
Thank you very much for listening this morning and this week. Don't forget to take a look at my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll have more business and finance updates for you on Monday. Joining me then are Alex Wong, Director at Alex KY Wong Asset Management, and Louis Coyce, Chief Asia Economist at S&P Global Ratings. Providing a view from mainland China will be Ben Cavender, Managing Director at the China Market Research Group. Have a great weekend.
Money Talk